And there is big correlation with this gold to silver ratio. But now we're starting to see this massive correction in the gold to silver ratio. So what's going to happen to the relationship between technology stocks and SPX stocks or Russell stocks? Hello there, Pablo Lucena, Masters in Trading. In front of you, you have Metals Edge. It's a little bit customized for the message that I would like to deliver. You may not be used to seeing the Edge tools in weekly time frames. Well, with Metals Edge, you're able to use other aggregation types that go beyond daily. In most other ones, you cannot. You get a little error, but during early development of the metals product, I made sure that I was able to do that for precisely this type of analysis, long-term stuff. Why am I here today? What is this all about? In the spread side, I have the gold to silver ratio, very standard. This is just how many ounces of silver does it take to purchase 1 ounce of gold. It's a very simple measure. However, since this is an Edge tool, we're doing it in dollars. At the peak in March, when the ratio went to about 120, right? The actual, gold GC divided by SI, the ratio went to about 120, meaning it took 120 ounces of silver to get 1 ounce of gold. But since this is the Metals Edge, the way we see that represented is in dollars and cents. We see a decline that took us from approximately 94,000 to currently somewhere in the, it says it right here, 59,000. The drop since this started has been, substantial, but there's still quite a bit more room to go. When else has this happened? When else has the gold to silver ratio dropped like this? There's been one other time that I could spot, and it was right before 2011, when the metals took off to the upside, and silver outpaced gold, and we had this event take place, the 2011 event in the metals. If you were holding on to a single silver future contract at the very peak, assuming again you had purchased it at the beginning of a 20-year cycle, since we're looking at 20 years of data, right? This is a 20-year weekly chart. So assuming that you had purchased a single silver future 20 years ago, which for the purposes of this example, 20 years ago happens to be August 7th, 2020. Excuse me, of the year 2000, right? Exactly 20 years ago. So if you had purchased that silver future, your gain at that peak would it have been 215 grand. How about for gold? 159 grand. Do you notice that there's a wide gap? When silver did this, gold was all the way down here. We can say, or we can just draw from pure visual analysis that the distance from the peak of silver to wherever gold was trading at, roughly speaking, that is, let me make this a little bit more accurate, and the gap between the two was approximately 89 grand. I just did that from doing this very rudimentary exercise here with you guys. Now, this chart, the lower chart, the ratio chart, shows us what actually happened for real and allows us to quantify it. So how much did it actually drop? Well, here it states a more accurate number of the gap between the two being approximately 100 grand. Here the ballpark was 89, 90 grand. This is saying 108 grand. Okay, we didn't do too bad. But look at the past 20 years. When else have you seen this? Never. Over the past 20 years, that is. We can go back to the 1980s, but for the sake of this example, which includes other equities, including the NASDAQ index, the Russell index, and the S&P 500 index, the start point is the year 2000. The only reason for that is because there is not enough historical data for the Russell, the RUT, at least that I can get my hands on. Now, let's look at this period in time, right after the start of the year 2018. Do you recall that there was a pretty big equity sell-off for the first time in a really long time? We actually had some selling in the equities at the beginning of February 2018. I sure remember that time frame. What we're seeing here is that it was precisely during that time frame that the ratio between NASDAQ stocks and S&P 500 stocks started creeping up into what I like to call bubble territory. The last time that we were in a NASDAQ bubble or technology bubble was in the year 2000. And you can see that these green lines all the way at the start of the data, they're above the zero line. They're positive. NASDAQ is more expensive than, in this case, the S&P 500, and in the other line, the other green line, it is more expensive than the Russell. Okay, technology is more heavy weighted or more expensive than small cap or normal cap companies. But after the period of the start of 2018, what we start to see is a shift where technology companies versus, it doesn't matter if it's companies in the Russell, it doesn't matter if it's companies in the S&P 500, it really doesn't matter. They have been going up. Technology has been going up since the start of 2018, or longer than that for that matter. But relative to the S&P 500 or relative to the Russell, it has completely left its prior ranges right around this time, right around that mid to early 2018. Now let's see what the gold to silver ratio was doing at that time, right? Since the gold to silver ratio is this blue line that we have plotted here, and it's moved significantly, how could it possibly affect these lines? So we see that in early 2018, as both of these green lines, which, for the sake of repeating it and making sure it's clear, what these two green lines represent are NASDAQ, technology, and Q outperforming, right, or doing better than the SPX index or the S&P 500 index and of the Russell index, okay, RTY RUT. So that is what these two green lines mean. This is the point when technology started becoming all powerful, and there is big correlation with this gold to silver ratio. But now we're starting to see this massive correction in the gold to silver ratio. So what's going to happen to the relationship between technology stocks and SPX stocks or Russell stocks. When have you ever seen anything like this? If I were to remove the comparison against the NQ versus RUT and just left it NQ versus ES, I believe that I could go back a bit further, and I had to modify this quite a bit to get it to display this, but I'm just showing you what is possible with the tool. Let me not display the RUT index. So if we take this to max weekly, just so that if it can take us all the way back to the 1980s, when we had ratio data, then I would definitely like to see that. And for gold and silver, we definitely had data. What becomes tricky is dealing with NASDAQ futures and ES futures, but I believe that they were around from very early on. If not, then for sure SPX, NDX. So let me just try one more thing here. Let me just delete this and try NDX versus SPX. And since user 1 is changing to SPX, user 1 is getting 100 shares, just like user 2, which user 2, is no longer there. User 2 will now get, will now be NDX. And to make this even, user 1 is SPX, so that is 50, and user 2 is NASDAQ, so this is a 20. The reason for this is due to the future delta multiplier. So let me try to make that same adjustment here. Get rid of RUT. For ES, I'm going to use SPX. And for NDX with a value of 20. I know it says for CL, but this is just for the purposes of this analysis. And for ES, I'm going to use a value of 50 shares. So ES is SPX, 50 shares, and CL is really NDX, 20 shares. Sometimes, whichever the shortest instrument happens to be it, in this case, I believe NDX is the one that has the least amount of data. And if I'm doing one of these analyses where I want max, that's the symbol I want to type up here. So that the data, which in all other symbols exists for prior times, but does not exist for, let's say, NDX, we don't run into that issue. Whereas if we start all the data wherever NDX data starts, then we know that all the other lines are going to have data. Right now, we're still waiting on one more, but we can see that we already have pretty solid data for NDX versus SPX, and here we're waiting for the NDX data to load. If we use these ratios down here, what do we see? This is a chart going back to 86. So when was the last time that technology was overvalued like this? Well, during this period, that's for sure, and now during this period again. So the key is when will it correct? And does the fact that the gold to silver ratio is moving down at this magnitude make a difference? I say yes, and the reason I say yes is very simple. After this humongous drop in the gold to silver ratio, with the bottom here in May of 2011, we start to see a rise of this ratio between gold and silver. Well, guess what? Since then, since 2011, what has this green line done? And the green line in this case is just the relationship between NASDAQ and SPX. All it's done is rally. And when did it enter into bubble territory? Using this max analysis, it entered it, somewhere around here, So if we get our actual hover tool to find the date, we find that this also coincides with our prior analysis. This is saying mid 2017. What we were saying earlier was early 2018. So, for the sake of the example, we're using weekly charts and we're going back as far as the data goes. A few months of difference is it's a rounding error. We can clearly see when we went into bubble territory. So what's the trade? What's the setup? The setup is this. Just like the setup for gold and silver was this, and we're currently trading that, as a matter of fact, very profitably. So if the gold to silver one has started to fall, but the NASDAQ versus the value stocks versus the Russell stocks has not, what does that tell you? Hope this has been informative. This is Pablo from Masters in Trading. Have a wonderful weekend. Bye-bye.